Debt. It's a word that definitely carries some weight, doesn't it?
Oh, absolutely. You hear debt and you think struggle, maybe constraint,
Yeah.
the sort of thing you want to avoid.
Yeah, like root of all evils, or even slavery sometimes.
Right.
And you see these massive numbers, right? Like nearly $15 trillion in total U.S. consumer debt.
It's staggering. And the average household carrying over, what, $5,300, it paints a pretty grim picture on the surface.
For sure. And chances are, if you're listening, you know this personally. Maybe it's credit cards, a car loan, student debt. It's pretty common stuff.
It really is.
But here's the twist we want to explore today. What if debt, especially for, the wealthy, isn't actually a bad thing? What if it's a tool, a way to build more wealth?
Now, that sounds counterintuitive, I know. It really challenges how most of us think about owing money.
Right. How can owing money make you richer?
Well, it comes down to how the debt is used. While those big aggregate numbers reflect widespread pressure, the strategies used by people with significant capital are often very different. They can use debt as leverage.
Leverage. Like a lever to lift something heavy.
Exactly. To accelerate wealth building much faster than just saving or making basic investments without borrowing.
Okay, I'm intrigued. So that's our mission for this deep dive, right?
Yeah.
To unpack this, we're going to look at, I think, 5 main ways the deep pockets use debt strategically.
That's the plan. We'll touch on international trade, real estate refinancing, that's a big one, then hedge fund strategies like shorting stocks.
Okay.
The whole world of Forex, foreign currency trading, and even something seemingly simple like your credit score.
So the goal is to understand how debt becomes this wealth engine, maybe offering you, the listener, a totally new way to think about it.
Precisely. It's about understanding that not all debt is created equal. The terms, the cost, and crucially, what you do with the borrowed money. That's what makes the difference. Strategic debt means borrowing to make more than you owe.
Got it. Okay, let's kick things off then. First up, debt and trade, specifically importing goods.
Yeah, and the first thought most people have is, borrowing to start a business? That sounds super risky.
And it can be, no doubt. Lots of businesses fail because of bad debt.
True, but in international trade, especially if you're sourcing from places like China, there's this interesting, almost hidden form of credit that's quite common.
Okay, tell me more.
Well, imagine you want to sell, I don't know, pens. You find a factory in China. Instead of you needing, say, $50,000 up front to buy the pens.
Which I might not have.
Exactly. The factory might actually extend you credit, but not as cash. They loan you the products.
They ship you the pens and you pay them later.
Essentially, yes. It's a practice that's apparently been going on for like 50 years. It's less about formal loan papers and interest rates and more about, well, trust.
Trust, really?
Yeah, and the expectation that you'll sell the goods and pay them back from the revenue. The factory is basically fronting you that inventory.
Huh. So the debt is the obligation to pay for the goods, not a cash loan.
Precisely. It's kind of embedded financing. And if you're good at selling, and our source really highlights how crucial sales skills are here.
Right. You need to be able to move the product.
Then you profit from the difference between the factory price and your selling price without ever having put your own cash down for the inventory itself. You use the factory's capital in a way.
That's clever. You're leveraging their production capacity. Key takeaway there.
Yeah.
Using debt or this kind of credit to get inventory without needing your own capital up front.
Exactly. It's a powerful lever if you can make it work.
Okay, interesting start. Let's shift gears to something maybe more familiar to people. Real estate. Mortgages, refinancing. How does debt work as a wealth tool here?
Real estate. Yeah, this is a classic. While we often think of a mortgage as just a big, long expense, using it strategically, especially with refinancing, can be incredibly effective.
I've even heard people joke you're paying extra taxes if you don't have a mortgage because of the deductions, but this sounds like more than that.
Oh, it is. It's about actively using the bank's money, the mortgage, to enhance an asset and then pull out the increased value.
Okay, walk me through it. Let's use the example from our source. Say someone has $200,000 saved, which, sounds like a lot, but maybe it's peanuts in some housing markets.
Right, depends where you are.
So instead of buying a perfect $200,000 place, the strategy is different. They find a property that needs work, maybe for $500,000.
Okay.
They put down 20%, so that's $100,000 of their savings. They get a $400,000 mortgage.
Still with the $100 K saved.
Right. Then they use another, say, $50,000, just 10% of the purchase price, to renovate the place, fix it up.
And this is the crucial step. Forcing appreciation. You're not just making it nicer, you're actively increasing its market value through those improvements.
So that $50,000 investment might take that $500,000 property and make it worth maybe $700,000 now.
Exactly. It's plausible, and that's when the refinancing happens.
Ah, okay, so you go back to the bank.
You go back, get the property reappraised at its new higher value, $700,000 in this case, and then you refinance. Let's say you get a new mortgage for 80% of that new value.
80% of $700K, that's $560,000.
Correct. A new mortgage of $560,000. Now, what do you do with that? First, you pay off the original $400,000 mortgage.
Okay, so 560K minus 400K leaves 160K.
Right. But remember, you also spent $50,000 on the renovations,
Yes. So subtract that 50K or two.
leaving you with $110,000 cash in hand.
Wow. So you've pulled out $110,000 tax-free, essentially, because it's loan proceeds, and you still own the property, which is now nicer and worth more.
That's the power of it. You use the bank's money, the mortgage, and your own strategic investment renovations to force the value up and then extract that created equity, leveraged appreciation.
Plus, as the source notes, you might be renting it out now for income, and you still have the mortgage interest deductions, potentially.
It becomes a multi-pronged strategy. Calculated use of debt to acquire, improve, and extract capital while building long-term equity and potentially income.
That makes a lot of sense.
Okay.
Let's move into something maybe a bit more exotic. Hedge funds and shorting stocks.
Right. Hedge funds are basically investment vehicles, often for wealthier individuals, designed to generate returns, sometimes using, let's say, less conventional or even unpopular strategies.
Popular, like betting against companies.
Exactly. Most investing is long investing. You buy something hoping the price goes up. Short selling or shorting is the opposite. You're trying to profit if the price goes down.
Is this the kind of thing we saw with GameStop, where hedge funds got squeezed?
GameStop was a very public, very extreme example of the risks involved when a short bet goes spectacularly wrong. But yes, that involved short selling.
So how does it actually work? If I think, say, Facebook stock is going to drop.
Okay, let's use that. Let's say Facebook is trading at $100 a share. To short it, you don't buy it. You borrow a share from someone who owns it, usually through your broker.
Borrow a share, okay.
And you immediately sell that borrowed share on the open market for $100.
So now I have $100 cash, but I owe someone a share of Facebook.
Precisely. Your bet is that the price will fall. Let's say maybe because Apple made privacy changes that hurt Facebook's ad business, you predict the stock drops to $70.
Okay, wishful thinking maybe, but let's go with it.
If it does drop to $70, you then go into the market and buy a share for $70.
And then I give that share back to the person I borrowed it from.
Exactly. You borrowed a share, you returned a share, your obligation is fulfilled. But you sold it for $100 and bought it back for $70.
Meaning I pocket the $30 difference minus any fees or interest for borrowing the share, I assume.
Correct. That's your profit. The
Yeah.
mechanism works. But, and this is a huge but, what if you're wrong?
What if Facebook stock goes up to $150?
Or $200. Then you're in trouble because you still have to buy that share back to return it. If it's $150, you buy it for $150, return it, and you've lost $50 per share, selling at $100, buying at $150. If it goes to $500.
The loss keeps getting bigger. There's no limit, theoretically.
That's the critical risk. Your potential profit is capped. The stock can only fall to zero. Your potential loss is, in theory, unlimited. It's an asymmetric risk.
Yikes. Okay. That sounds dangerous.
It absolutely can be, which is why, as the source mentions, hedge funds doing this usually have teams of analysts trying very hard to get the prediction right and manage that risk.
So, takeaway. Using borrowed asset stocks, in this case, to profit from falling prices, but with massive potential downside. High risk, high reward, needs expertise.
Perfectly summarized. It requires deep market understanding and very careful risk control.
Okay, let's move to another complex area, Forex, the foreign exchange market.
Right, Forex. Simply put, it's the market where currencies are traded. Think dollars, euros, yen, yuan.
And this is essential for just like global business, right? If a U.S. company has employees in China.
Exactly. They need to pay those employees in Chinese yuan, so they have to exchange U.S. dollars for yuan. That happens in the Forex market. Billions, trillions, traded daily.
And the values of these currencies go up and down all the time.
Constantly. Based on all sorts of things, economic news, political stability, and a big one is central bank decisions, like the U.S. Federal Reserve raising or lowering interest rates. That affects the dollar's strength.
Okay, so people trade these fluctuations, but what makes Forex stand out in terms of debt or leverage?
The amount of leverage available is, well, it's huge. Our source mentions you can potentially borrow up to $100 for every $1 of your own capital you put up.
Wait, 100 to 1 leverage? Seriously?
It can be that high, yes.
Yeah.
It's a defining feature of retail Forex trading. This means you can control a very large position in a currency pair with a relatively small amount of your own money.
So if I put up $1,000, I could potentially control a $100,000 currency position.
That's the idea. Now think about the impact. Currencies usually move in small percentages, right? A 1% move is actually pretty significant.
Okay.
But if you make a 1% profit on a $100,000 position that you're controlling with only $1,000 of your own money,
That 1% gain on $100,000 is $1,000, which is a 100% return on my initial $1,000.
whoa,
So-
the gains get massively amplified. But
There's always a but with leverage.
so do the losses. A 1% move against you wipes out your entire initial $1,000. A 2% move against you means you owe money.
Okay, so incredibly high potential returns, but also incredibly high potential and very rapid losses.
Exactly. Our source mentioned a previous deep dive on Forex, hinting at its complexity. The key takeaway here is using extreme leverage, massive borrowing relative to capital, to speculate on currency movements. Very high risk.
Definitely sounds like it.
Yeah.
Okay, let's bring it back down to earth a bit for our last point, something that seems more every day. Your credit score. How is that a wealth-building tool using debt?
Well, we usually think of a good credit score as helping us get a mortgage or a car loan, maybe a credit card with rewards, personal stuff.
Right.
But for businesses, for entrepreneurs, a strong credit score is actually a really powerful asset. It unlocks access to capital.
Capital for the business.
Yes. The source gives the example of financing purchase orders. Imagine you land a huge order, but you need money now to buy the materials or inventory to fulfill it, and you won't get paid by your client for 60 or 90 days.
Okay, a common cash flow crunch for growing businesses.
Exactly. With a good business credit history, which stems from good personal credit often, you can often borrow relatively cheaply to bridge that gap. You use debt to finance the fulfillment of a confirmed order.
So it's about differentiating types of debt. Again, this isn't like racking up high-interest credit card debt for consumption.
Not at all. This is strategic borrowing, often at much lower interest rates, enabled by your proven track record of paying back debts, your good score. That score basically tells lenders, this person, this business is a lower risk.
And lower risk means better terms, more willingness to lend.
Precisely. Lenders want to lend money. That's how they make money. There's vast amounts of capital out there. Banks can even effectively create money to lend. A good credit score puts you in a prime position to access that capital favorably.
So the takeaway is, build and protect your credit score, because it's not just personal, it's a key that unlocks potentially cheaper debt you can use strategically for business growth and investment.
That's a great way to put it. It's foundational for leveraging other people's money for your own ventures.
Okay, wow. So wrapping this up, we've covered quite a range. Using supplier credit in trade, forcing appreciation and extracting equity in real estate through refinancing.
Yeah, the refinancing play.
Betting against stocks by short selling via hedge funds.
High risk there.
Using massive leverage in Forex trading.
Even higher risk, perhaps.
And finally, just leveraging a good credit score to access business capital. It really does paint a different picture of debt.
It absolutely does. It drives home that critical difference between, let's call it bad debt, high interest, maybe for depreciating assets or consumption, and strategic debt used for investments or business growth that ideally generates returns higher than the debt's cost.
It's definitely given me a lot to think about. And for you listening, thinking about these strategies, even the complex or risky ones, how does it maybe shift your own view of debt?
Yeah, perhaps it's not just this monolithic negative thing to be avoided at all costs. Maybe, just maybe, it's a tool, a potentially powerful one, if understood and used very, very carefully.
A tool that, in the right hands, seems capable of building significant wealth. Definitely something to mull over.